Hello everyone, today we are going to start the video edition of the knowledge series. Now the first topic that we are covering is a very important topic, which is taxation on investments. Now often we have seen that most investors think of tax planning activity only at the end of the year. But to our mind, this planning should be a continuous process and not just a one-time activity. If most investors understand certain key important provisions of the Income Tax Act, it can help them and guide them to offset their taxes or to manage their taxes or to plan this activity to a large extent. Now, which are these provisions? We are going to break this up into two parts. Part number one is first understanding what are the sources of income an individual can have, so that then they can plan what is the tax planning activity on it. And the second part would be what are these key provisions, which is a key 9 provisions which we have spelled out today. Let's start with part number one. What are the incomes that an individual may have? The first income head is income from house property. This is very simple. Anybody who owns a house and if he rents it out, the rental income that they get is classified under the Income Tax Act as income from house property. The second is income from salary. This is the most simplest anybody would understand. Is if you are employed with an organization, you get a salary, which is clubbed under income from salary. Then we have income from business or profession. So if you are engaged in any business activity and if you earn any income of that, it comes under income from business. And if you are a professional like a lawyer, doctor, etc., you get professional fees, so it comes under income from profession. Then the fourth important head under the Income Tax Act is the capital gains on any investments that you make. So these are all on investment transactions, you would get some kind of capital gains. It's clubbed under income from capital gains. And the last is income from other sources, which is nothing but your interest income in your savings bank account, or you have got some form of dividend. That all comes under income from other sources. So these are the 5 important heads that classified under the Income Tax Act 1961. So now let's understand which are these 9 key guidelines or provisions of the Income Tax Act an investor needs to keep in mind while doing his tax planning activity. The first is to do with section 70 to 74 of the Income Tax Act, which is to do with set off or carry forward of your losses. First, if you have any loss from house property, which means that if your rental income is lesser than the interest you are paying on the housing loan of that house, you will incur a loss that can be set off against any income heads, but only up to rupees 2 lakhs. If you have a loss from business, that can also be set off against any income head except for salary. If you have a loss from your investments, which is your capital losses on any asset like short term or long term, that can also be set off. So for example, short term losses can be set off against long term and short term gains, whereas long term losses can only be set off against long term gains. The good news is, after setting off, if there are any more net residual loss which is left, that can also be used in the subsequent years and can be carried forward for the next 8 years. However, in the subsequent years, it can be set off against only the same income heads. So for example, in the first year, if you have taken business loss and set it off against capital gains, from the second year onwards, any net residual loss that you would have carried forward can only be set off against the head of business income. The second most important provision that an investor needs to keep in mind is the section 54 of the Income Tax Act, which is to do with sale of residential house. Now, any long-term capital gains arising out of sale of residential house can be exempted from capital gains tax if the capital gains are reinvested back into a new property. So, for example, if an investor sells his property and capital gains arising out of this is rupees 2 crores, and if he buys a new property worth 2 crores, then he will be exempted from the capital gains tax. Now, one thing an investor needs to keep in mind here is the time period to purchase this new house. It has to be within 2 years from the date of sale or 1 year prior to date of sale. In case of a construction of a new house, it has to be within 3 years of date of sale.